Hello, my name is Ben Lofthouse and I run the Henderson International Income Trust, known as HINT. We launched the trust almost exactly a decade ago, at the end of April, and we launched it into conditions where there was considerable uncertainty. Interest rates were very low, and the UK market had a significant amount of concentration in terms of dividends. And I have to say, kind of looking at conditions in the world right now, we're still in a very similar situation to that. So interest rates remain very low. We've just come through a period of considerable uncertainty, and I will run through with you some of the positioning of the trust and potentially, where we see the best growth and income opportunities for hopefully the next decade. In terms of positioning, the fund is always diversified by region and stock. We don't have any stocks over 5%, and the regional split is roughly a third, a third, a third. At the moment, we have 37% of the fund in Europe, which is a slightly higher weighting than normal. And this reflects the fact that we see significant value opportunities there. The market has been very unloved for a few years, partly due to Brexit and people worrying about the outcome of that, and partly because it is an exporting region. And so in periods of recessionary environments or periods of uncertainty, you do see sometimes investors shy away from European stocks. But it does have a number of world-leading companies in a number of different fields, and we do see considerable value in the region. We have about a third of the portfolio in Asia Pacific, and there some of the attractions are twofold really. One, there is an amazing technological industrial base there around things like semiconductors and manufacturing in those areas, and also they have a younger demographic and probably more room for an emerging middle class to come out as a result of the lower debt burdens and lower GDP per capita. In the US, the attractions for us, slightly similar to Asia, are again world-leading technological companies, companies like Microsoft and Texas Instruments, kind of leading in their fields, but also a very broad base of companies that lead in areas like consumer staples and pharmaceuticals. In terms of sector positioning, we also remain widely diversified. The top sector by weight we have at the moment is the financial services. It's just under 20%. The next largest sector is technology, around 17%. And then the next two are pharmaceuticals and industrials. So quite diverse, different drivers for each. In terms of what we see of interest in financials, companies have spent many years in restructuring, building up balance sheets post the financial crisis, learning how to deal with lower interest rate environments. And actually, they've come through this crisis quite well, many of them. The dividends are very attractive, and we see them being quite well positioned for a world where economic growth is picking up. And maybe, just maybe, we see higher interest rates, which would be very beneficial for many of them as well. One of the advantages for a company like ours, Henderson International Income Trust, is that we can access different companies in different regions. And so with an area like the financial services sector, we can diversify some of the regulatory risk there by having holdings with different regulators. So we do diversify the companies in these areas across a number of countries. In terms of technology, it's not always the most obvious sector when people think of income stocks. We have in the UK, certainly, and in Europe, we don't have as many income-paying technology companies. But elsewhere in the US and Asia, you do find well-established companies, very strong balance sheets that have the ability to invest in the future whilst paying dividends to shareholders to wait in the meantime. And then finally, in the pharmaceutical sector, this is a sector that has come up through this crisis quite well, has shown a considerable amount of innovation in coming up with solutions to the coronavirus. The sector hasn't performed particularly well, actually, particularly the larger cap pharmaceutical names, partly because they're not as exposed to recovery. So certainly at the moment, their earnings growth isn't as exciting as some parts of the markets, but we do see very well invested companies there trading at very attractive valuations. And so we have been building up the weight in that sector. Over the last decade, the net asset value total return has been approximately 130%. That equates to around 9% a year cumulatively. And in that period, including that return, has been a dividend that's grown each year slightly more than inflation. I think, when you look at those returns, it would suggest it had been plain sailing. And I think we all know the last decade has seen considerable change. We've had trade wars, we've had Brexit, and more recently we've had something completely unprecedented for us, which is the pandemic. So I think, at the moment we see a large range of interesting opportunities across a number of sectors, and that makes us excited about future returns. We also see yields that remain considerably above fixed income and bonds of the equivalent companies, and which are growing. So I think for us, we remain excited about the possibilities within the portfolio. We can't tell what happens on a 6-month to 12-month basis, but hopefully, across the next decade, we can replicate some of the returns that we have done for this one.